This is my screencast assignment on accounting for receivables. A receivable is the representation of the company's claim on the assets of another entity, with the most common type of receivable being an account receivable. This account receivable is the amount whereby the customer owes the entity based on prior purchases from the company. It is, however, an amount owed and not an increase in the cash account within the current asset component of the balance sheet. But how are these receivables then recorded? Let's examine the following example. Mark purchases a bike from John on the 20th of March. John sells this bike for $1,000 to the customer on account. As a result, John would record this as revenue earned and the receivable following the sale. This would look like the following. 20th of March, accounts receivable are increasing or debited by $1,000 and the sales are credited by $1,000. Overall, the asset component increases by $1,000 and the equity component increases by $1,000. Mark then pays for this purchase on the 20th of June. The two accounts affected would be the cash account and the accounts receivable account. This would mean that cash account increases and the accounts receivable account decreases. John does the following. 20th of June, cash debited $1,000, accounts receivable credited $1,000, meaning the asset component both increases and decreases through the payment of cash. With this said, receivables are not always able to be collected. Losses arising from the inability to collect a receivable is recorded as a bad debt expense and is a normal part of any business, especially considering that this bad debt expense is an operating expense for the company. To account for this, there is both the direct write-off method and the allowance for doubtful debt method. The direct write-off method is used when the company deems that the receivable is uncollectible, ultimately removing the receivable from the records. Therefore, this pending receivable is simply written off. To show this in accounting records, there is the debit to the bad debt expense for the amount of the receivable and a credit or decrease to the accounts receivable. As the direct write-off method violates the Generally Accepted Accounting Principle Guidelines, or GAAP, entities are generally prohibited in using this method. There is also the allowance method. The direct write-off method only accounts for the uncollectible receivable through the single entry, whereas the allowance method splits the uncollectible receivable into two separate entities. One records the estimated percentage of the receivable to be uncollected, another writes off the receivable when they become or are deemed uncollectible. The amount of the allowance is created as a percentage set by the entity based on uncollectible receivables from previous years. The entry is firstly recorded during the period where the transaction occurs. It is recorded as a debit to the bad debt expense and a credit to the allowance for doubtful debts. When the receivable is received, there is a debit for the allowance for doubtful debts and a credit to the accounts receivable. As this principle follows the generally accepted accounting principles, this is the method employed by companies.